Alpha Data, 100 Lot Trader. It is time for a broader market update because I believe the volatility expansion event is nigh. I'm going to give you an update on my ongoing VIX trade, take a look at oil, silver, gold, long-term treasuries and treasury yields, as well as the S&P 500 to give you a sense of what I see about to unfold here. Let's start with my VIX position. I bought out of the money February contract VIX calls on December 3rd or 4th, basically at the bottom. The reason for this was pretty simple. I actually just sort of got lucky. I noticed that on the 50 and 100-day Keltner channel, 2 standard deviation range, that we were statistically far undersold on the VIX in the context of volatility. This was very clear to me, so I went ahead and bought. I bought out of the money calls, deep out of the money calls, and they have literally been profitable ever since I took that trade. I hedged that position right around December 17th at the 20-day high, thinking that we would bounce around in a range. And then we saw the big volatility expansion. So what this told me was that, no, I didn't miss it. Actually, another wave is coming. Because before this channel was confirmed, I was thus able to identify a market structure shift in an ascending channel based on the basing pattern here and the top. And what has happened is that the bid on volatility has continued. Volatility is currently in an ascending structure, and the look is up into this range here because we have short volatility liquidity that needs to be run out of the market. This is what has had me long volatility for quite some time. This was obviously liquidity, probably actually intentionally sat there to begin this move, but this is not going to stand from a market maker's perspective. This needs to be handled. Thus, I have been anticipating increasing volatility moves on the VIX, and I believe we are getting closer to it. This has been, I'll go back to the February contract because this is actually what I've been trading. All right, so we have a basing pattern. This is the tell. Relative equal highs on volatility, engineered liquidity. We are in the bottom 25 percentile of the 20-day range. This is an optimal trading zone simply because getting a 3-to-1 is quite possible when you are buying in the bottom 25th percentile and you are trading up into a premium. But this is where the existing liquidity is, so I anticipate us moving up to at least, well, the absolute minimum would be 22, but when volatility expands, it tends to expand pretty violently. So given the pre-existing volatility liquidity up here, we could see a pretty big move. This is what I've been waiting for. So are there mechanisms to see this? Is there something here that might actually tell us that this is possible? Well, yeah, there is. I've been watching this as well. Let's look at the 10-year treasury yield futures. I outlined this actually in a trading channel a while ago. So we have relative equal highs right here. It's not the cleanest, but this is not resistance. This is the move that's going to be run through. I've been watching silver and TLT, long-term treasuries, very closely because typically the top of a 20-day range is where I would sell. In this case, what I determined was that we probably were seeing a minor retracement and then the bounce. And when we see a bounce up of long-term treasury yields up into the, well, above 4.5 into the, if you look at this channel, what it suggests is we could see yields, going up to 6%, which I don't actually think is likely, but this is a long-term ascending channel. We had actually only been, we had been descending for some time, but this is really, when you look at it, this was just a consolidation, and now we have broken that channel. So the yield move appears to me to be up. So what does that mean? I would be bullish on oil and bearish long-term treasuries. So do we see any evidence that oil is popping? Oh my goodness, in fact, we do. Oil has been riding a multi-year consolidation, symmetrical triangle. Now, right now, it's still continuing to move within its range, and it could stay within this consolidation range. But from where oil sits right now to residing within the existing multi-year consolidation structure is still a fairly sizable jump in the price of oil. How, when I look at oil prices, what do I expect to see in terms of the stock market response? Well, I happen to expect to see oil companies catching a bid. And in fact, I opened out the money call positions on ExxonMobil just, in fact, at the bottom. I would love to say that this was anything other than luck, but it is where luck and experience come together. I bought at the bottom just because I have bought in this area before and had success. This is a very large scale order block in a large multi-year accumulation block, which takes the form of an inverse head and shoulders pattern. Super duper wish that I could find my brush. Yeah, this right here. So it's not obvious. It's literally over the period of several years, but we've had a sell side liquidity run into a inefficiency in delivery for this large buyer here, and ExxonMobil, which leads is 21% of XLE, has actually been going up for the last 2 weeks. Now, that could easily be short covering, and in fact, it certainly is. I bought cheap out the money calls from someone, and the people I bought them from were ones who went short those out here and are trying to get rid of them. So, ExxonMobil has formed a basing pattern. Here, we've got a high, higher high, higher low, higher high, all within the bottom 25th percentile, the discount range of the 20-day price on ExxonMobil, and I see kind of a lot of potential upside. That's why I bought out of the money calls up there. You know, the ExxonMobil is a sleeper trade. You get really lulled into the fact that what is happening here is a large accumulation block from an institutional player, but it is certainly capable of moving 20% in a very, very short amount of time. My calls are long dated. That may not be what's happening here. We could very much revisit this order block, but I mean, I don't have a ton at risk, but these same out the money calls have pretty much been profitable since I bought them, which was right around here. And that typically indicates to me that, one, there's an implied volatility bid on those calls, and that, two, I may have actually correctly read the move. We'll see if ExxonMobil moves up into this 110 into the premium range, breaking this former high. It still could just be liquidity run. Really, we would know once that move unfolds, and then what happens when it gets back down to equilibrium, or ideally back into this price range. But right now, I see reason to believe that a bid on oil is also unfolding. What does this mean for the stock market? Well, let's take a look at the structure of NASDAQ futures. This is a bearish order block. These are ICT principles. Bearish order block. Let me make it pretty. Bearish order block. This week is not over, so it's not actually accurate to say that this is a bearish order block, but it certainly has taken that structure. Let me get rid of some of these. And what do we have down here? Well, we've got a long, obvious weekly wick with a move down into the descending channel, running through liquidity. We've got multiple weekly lows here, here, here. The market loves to take these out. So what I am seeing is a volatility expansion move, a run on sell side liquidity that could look very scary. But I've actually already outlined this process in a couple different places. The pump and dump that I called on NVIDIA yesterday has, in fact, is unfolding. I believe right now that what the volatility expansion will be through this range, through 135 to I don't know, 125. Take all of these measurements with a grain of salt. I was clearly I'm often right in the basic kind of unfolding, but the magnitude up or down is often an underestimate. I have found. So yes, I anticipated a bounce here, but it was much more aggressive than I originally had thought. And this move almost caused me to drop my bag. But I actually added on to my position, which was hard, but I did. So I have now more puts in my hand that I am going to use to hedge even more purchasing of NVIDIA. Because, so I'll explain to you why do I think this move will not last terribly long? Well, because I'm a derivatives trader, and what I'm going to do when this happens, when this move unfolds, when this unfolds, and I mean it could be bigger. I have no true idea of what the magnitude of this could be. It could be tight. It could just be coming up here. You know, it could run through this area. It could expand aggressively. I truly don't know. There are probably good ways to measure this, but I don't have them. But what I can tell you is I will make money on this move. I will make money both ways. I'm hedged risklessly on QQQ, so I'm anticipating at least a move down to 500. Once I get into this area, I am short calls that are long dated and approaching worthless. So I'm going to close those for a net riskless, net profitable, holy grail trade, which is riskless convexity to the upside. I will talk about riskless convexity more. I plan to dedicate quite a few videos to this idea, but I am targeting this area for my own trading reversals, as I am targeting this area for entering long onto NVIDIA. And on the volatility side, once this expands, I am going to buy lots and lots and lots of really, really cheap puts. Really cheap out the money puts. And I'm going to sit on those because I will have used the profit from this trade to pay for them. And then I don't care. I really, if I'm trading with profit or from the position of profitability, those are the easiest possible trades to do. I would never buy, a whole bunch of approximately 0% chance success options contracts with any substantive amount of money if it were principal. But if it's profit that I have generated, and I know that the VIX is one of the most reliably mean reverting instruments out there, I am fully happy to ride this move and then reverse because I don't have any risk on the trade and the potential profit is
absolutely immense. But because that's exactly what I'm planning on doing, and you can be pretty certain other advanced options traders are going to see the same opportunity, you can thus reasonably infer that from that point, volatility will get sold and sold very hard. When volatility gets sold, that tends to have a supportive effect on stocks and the stock market. And that's how I can see a dynamic reversal like the one I've outlined on NVIDIA actually unfold. Does any of this have to happen? Well, no, of course not. There are no guarantees in markets. I could be very wrong. It would not be the first time. But thus far, the shots I have called on this play by play have been pretty accurate. And I can say that confidently because I have videos to support it.